This is the study session on equity investments and the reading on market organization and structure. Just a quick comment on this series of 6 readings. Notice that we start with organization and indexes and efficiency and overview, and then we end up with equity valuation. So these first couple of readings, the LOSs, are going to sound an awful lot like describe or define. A couple of calculates in there. But once we get to the concepts and basic tools of equity evaluation, we're going to do lots more calculate. All right, first LOS, explain the main functions of the financial system. And there are three of these here. The one that I like best among the 3 is the third box over there, the allocation of capital to its most efficient uses. And you have these borrowers who are in need of capital, and they are competing for that capital, whether it's a government, but in particular, whether it's a business, they're competing for capital. And the investors, whether they are shareholders or bondholders throughout the world, these individuals and institutions have the capital, and they're going to lend it only to those people who are going to have its most efficient use at hand. Now, within that context, there is an economics reason for this. Go back to what we learned in micro and even macro. There's always an interest rate or a rate of exchange between consumption today and consumption tomorrow. And so the financial system then provides a framework for the discovery of that rate of return, so that, let's go over to that far right box, so that the borrowers and the lenders over there have an idea of what interest rate is going to be charged for the allocation of capital. And then the box on the left suggests that individuals and institutions have a purpose for the financial system, and that's borrowing and raising capital, but managing risks. Boy, we just spent a whole bunch of readings on risk management. And then facilitating trading of assets. And then this is pretty key here, the exchange of information. Every time 2 parties trade, the borrowers and lenders, every time 2 parties trade, there's probably some information that can be inferred from that trade. How about a description of classification of assets and markets? All right, so assets can be financial or physical. It can be financial securities like stocks or bonds. They can be currencies, and they can be contracts. Or they can be physical assets like grain or oil, and some real assets like maybe an apartment building or a mall or a beach house. Markets are typically classified on the basis of a couple of different variables. The first one is timing of delivery. Sometimes you can deliver the asset today, sometimes you can deliver it tomorrow, sometimes you can deliver it in a month or a year. They're classified based on who the seller is, the maturity date of the instrument. Remember that equities, they don't have a maturity date, but bonds, they all have maturity dates, whether it's 1 year, 5 years, or 10 years. And then by type of securities. All right, let's classify the markets based on timing of delivery. Let's start with the spot market, which is the market that we almost always operate in as consumers. When we go to the food store, that's really the spot market. We buy a pound of potatoes and we pay for it, and we get to take them home today. So think of a spot market is any kind of a contract in which there is immediate delivery. But sometimes buyers and sellers don't really want immediate delivery. They want delivery at some time in the future. And so there is a series of markets that allow for delivery at some time in the future. The simplest of all these is a forward market, in which 2 parties agree to trade an asset, like maybe an interest rate on a mortgage loan or maybe a currency. They agree to trade that asset at some time in the future. So essentially, or at least theoretically, there's really no money that changes hands today until it's settled at some time in the future. Now, futures markets are really just standardized forward markets, and those futures contracts are traded on an exchange, and so they're characterized by lots of different stuff that we'll talk about at a later date. And options markets are similar. You can buy an option which gives you the right but not the obligation to buy an underlying asset at some time in the future. And depending on the option type, you can always exercise that today or tomorrow or at the expiration date. But the important thing is that the delivery of the underlying asset probably occurs sometime in the future. One more quick comment about the timing of delivery is that even though futures and forward and options market call for the delivery at some time in the future, many of these contracts are just cash settled because it's way easier. How about who the seller is? Primary market, excuse me, primary market is the market for newly created securities. When a company issues a bond or issues shares of stock, it's creating that financial asset. And so the funds flow from investors directly to the issuer. And this happens with governments as well. Secondary markets, when you think of secondary markets, always think of the New York Stock Exchange. And here the funds flow between and among investors. And the issuing party, whether it's a business or a government, doesn't have any part in the secondary market. How about the maturity date of these contracts? Money market assets are those that have maturity dates of 1 year or less. Good examples of money market securities are things like treasury bills and bankers' acceptances and commercial paper. Capital markets, on the other hand, have maturities of over 1 year, and these are debt and equity. Traditional markets are for debt and equity. This is how borrowers have traditionally raised capital through the bond market and through the equity market. But in the last, at least 10 years, but probably going back maybe 20 or 30 years. But in the last 10 years, alternative markets have really become quite popular. And these include all different sorts of stuff that is not considered traditional. And that includes hedge funds and commodities and collectibles and movie memorabilia and equipment. Now, the big difference here between the two is that in the traditional markets, there's probably a much higher degree of liquidity than in the alternative markets. And just for an example, remind yourselves, did you sell your home or did you buy your home, in 15 minutes? And the answer to that is no. All right, here's an LOS that asks us to describe a variety of things. So let's start with the types of securities. So fixed income securities. These are notes and bonds that mature in greater than 1 year. And what the borrower does is make an explicit promise. The government or a business will say to the bondholders, they'll say something like, hey, we need a couple $100 million, or if it's the federal government, at least here in the United States, it's 10 or 20 or 50 billion. We need this capital. Will you lend it to us? And the bondholders say, what do we get out of it? And the executives of a business and the government officials, they say, hey, we will pay you interest at regular intervals, and we will return your principal at maturity. And so I always think of this as an explicit promise. Here's a good table of some examples of fixed income instruments. Notes usually have maturities of 5 years or 10 years. Bonds usually have maturities greater than 10 years. And it's interesting, there's nothing fascinating about the 30-year bond. It just happens to be the maturity date that commercial bankers came up with the old days to give out mortgage loans. It could be 40 years, it could be 20 years, it could be 80 years. There's a company out there that's issued a 100-year bond. I'll let you guys try to figure that one out. Convertible bonds. This is a category of bonds that have embedded options, convertible bonds and callable bonds and puttable bonds. We'll talk about those embedded options in another reading. And then over on the short term, treasury bills, savings accounts and time deposits and commercial paper and money market instruments. How about equities? This is very different. This is very different from a bond issue. When when a corporation issues equities, what it's doing is telling the investors the same thing that they did when they issue a bond. Hey, we need your capital. But instead of making an explicit promise to the bondholders, I promise to pay you interest and I promise to pay you principal, the executives and the board of directors at a publicly held corporation say, I'm going to pay you a dividend if I feel like it. And the if I feel like it really means that if our company is successful. But I don't have to pay you a dividend. So I like to think of this promise as kind of a vague promise. I might pay you a dividend and you might be able to go to the floor of the New York Stock Exchange and buy low and sell high. So the vague promise involves possible dividends and possible capital gains. But if I fail to deliver on that promise, then the shareholders have no course of action. Remember the bondholders, if the executives or the government fails to meet that explicit promise, then we can bring about the elements of bankruptcy. But no such course of action is available to the shareholders. Limited liability, we talked about that in a previous reading. All right, so what kind of equities are there? There are common stocks, and this is common, right? Common sounds like the most commonly issued. And so what do common shareholders get? They have the right to receive a dividend if it's paid, and they have the right to vote at annual meetings on important items like electing the board of directors. And if in fact the company is liquidated, then they have a right to share in the proceeds. Preferred shareholders, they really have almost no rights. They don't have a right to vote. They don't have a right to receive the dividend, although the dividend it's mostly fixed and they get priority over the dividend that is paid to the shareholders. And then warrants are options that are issued by the company. And typically these warrants give the owner of the warrant the right, but not the obligation to buy shares of stock at some exercise price at some time in the future. There's an expiration date on the warrant. But these things are not issued by themselves. They're typically coupled with a bond issue or a preferred stock issue to make them more attractive so that the company can raise more capital initially. And how about pooled investments? I'm betting you guys know about mutual funds, but there are also some other things out there like trusts and hedge funds. And when you become an investor in a pooled investment, you receive shares. And I bet you know that when you look at your mutual fund statement, you might own 103.257 shares of that mutual fund. And here are some good examples: mutual funds, exchange traded funds, asset-backed securities, which are really a cool instrument, and then hedge funds. How about contracts? Contract is an agreement among traders to do something in the future. And this is pretty much characterized in the derivative market. So what did we talk about earlier? Futures contracts and option contracts and swap contracts. And so good examples include a contract based on the price of gold would be considered a physical derivative. So what we could do is say, hey, I agree to buy gold from you at $1,500 per troy ounce. Anybody know the difference between an ounce, a regular ounce, and a troy ounce? I think it's 3 grams. How's that for some silly information that's not valuable at all? So that's a physical derivative. And then how about an option on a share of stock? That would be a financial derivative. And there's the list of what I just mentioned: forwards and futures and swaps and option contracts. We'll talk at length about those in another reading. How about commodities, precious metals, and energy products? So these are things like oil and natural gas and grains and corn and barrows and gilts. My wife and I lived in the Midwest for some time, and every night on the news we were told about the barrows and the gilts. And then even carbon credits. This has become really important with climate change. Now, the cool thing about these commodities and real assets is that an investor can get exposure through the spot markets by investing in an apartment complex or in a real estate investment trust, or indirectly through forward and futures markets. Currencies, of course, are monies issued by national monetary authorities. We have the Fed here in the United States. They trade in foreign exchange markets. And think about this. The equity markets are about this big, and the debt markets are about this big, but the foreign exchange markets are about this big. I mean, it's by far the most massive market that's out there. The rate of exchange is called the spot exchange rate, or the spot rate. And so many people are familiar with the spot rate when they get off an airplane in a different country and there's some man or woman there waiting to exchange your currency. You probably don't get the best rate there. But the spot rate that you read about in the Wall Street Journal, or that you search for somewhere online, that's probably the spot rate between and among financial institutions for a minimum amount, like maybe $1 million. And those transactions settle within 2 days. How about types of financial intermediaries? So we have brokers. What they do is they just buy and sell for their clients. Block brokers, they do the same thing, but they do it in large trades. Investment banks, of course, the investment banking function is to advise and to distribute and to help governments and businesses raise capital. And then stock exchanges and bond exchanges and derivative exchanges. They provide the mechanism under which individuals and institutions can meet their return objectives by taking a position in an asset. And there are alternative trading systems and ECNs that act very similarly to exchanges, but they have maybe little regulatory authority, with the exception of making sure that the trading is, legal and all that kind of stuff. Dealers, on the other hand, they can fill their clients' orders by taking a position. The dealers will have an inventory. My great example of a dealer is about, I think it's maybe 15 or 20 years ago. The great rock and roller David Bowie issued a $25 million bond in which he was going to repay that bond based on the royalties that he received by all of his great rock and roll songs. And this was issued through an investment banking firm, and the investment banking firm just loved these bonds so much that they kept them for themselves. And so they received all the interest and then the principal. And then insurance companies, of course, they provide people with a mechanism to transfer risks. And arbitrageurs are those really, really smart individuals with lots and lots of computing technology who have access to tremendous amounts of capital. And so their idea is to generate a positive return without taking any risk and without using any of their own capital. And of course, the traditional depository institutions like commercial banks, we used to have tons and tons of savings and loan associations back in the 1980s, but I don't even know if we have any more of those. We have some. Credit unions similarly are declining in number. And then securitizers. These are financial institutions that create a financial product. So let's go back. Remember I said to you how cool these asset-backed securities are. Let's just take a very quick example here. Let's suppose that you're a commercial bank, and what you do every day is that you evaluate and grant mortgage loans. And so let's suppose you have $100 million of mortgage loans on your balance sheet. And so what do you have to do every day? You have to get up and you have to go call all of those $100 million worth of people and say, hey, you owe me interest and you owe me principal. And you have to do this for 30 years. You have to do this for 30 years to kind of get your money back. Well, what these financial institutions can do is they can package those mortgages together and sell them in the secondary market. And they can get their money back today. And so what this does is it allows the commercial banks and the mortgage banks and any other kind of a financial institution to generate income today, to return their capital so that they can reinvest it in positive net present value projects. But what it also does is it allows investors throughout the world to have access to markets that they otherwise would not. And here's a good example of this borrower who takes out a home loan from a mortgage broker. And so what does the borrower do? Make those monthly payments to the broker and receives the loan initially to buy the house. But then what the mortgage broker does then is sell those packages of loans to investors like you and I or institutions. And then once those monthly payments are received from the homeowners, then the mortgage broker then passes those along to the asset-backed, in this case, the mortgage-backed security holder. And lots of times there's a special purpose vehicle set up to keep track of those assets of that asset-backed security. Now, the fascinating thing about special purpose vehicles is it removes the assets from the firm's balance sheet, but it also removes the loan. I encourage you to go back and see what happened with Enron with those special purpose vehicles. How about comparing positions an investor can take in an asset? You can either take the long or the short position, and just think of it in these simple terms. If you take the long position, you're going to benefit when prices rise. If you take the short position, you're going to benefit when prices fall. So when we go to the New York Stock Exchange and buy shares of stock in a company like Johnson & Johnson or Procter & Gamble, we're taking the long position because we benefit when prices rise. But we can also take the short position and benefit when prices fall. Now, here's the idea of selling short in the equity markets. What you have to do is you have to borrow the securities. I mean, you're going to sell today and then buy back later. So what do we do to generate a capital gain? The long position, and we know this from the time we were young children, the long position buys today at a price of 100 and then wants to sell at a price of 150 at some time in the future. Buy low and sell high. The short seller, on the other hand, wants to buy low and sell high, but do it in the reverse order. So the selling comes first. So you sell an asset that you don't have. Well, the only way you can sell an asset that you don't have is by either stealing it, which of course we're not going to do, or borrowing it. And so what the short sellers do is they borrow securities from their investment banking firm, and then they go to the market and sell. And here's a little table that shows you that we're going to sell at $80. And then what happens? The price falls, and the price falls all the way down to $25, and then we buy it back for $25. So notice we bought at $25 and sold at $80, but we did it in the reverse order. How about an LOS that asks us to calculate something? All right, so we're going to calculate leverage ratio and a rate of return, and then a margin call price. So let's go ahead and work through some of these definitions. A margin loan is simply that you can buy $10 worth of stock and you only have to put up $4 or $5 or $6. When you borrow some capital from the investment banking firm, that's called a margin loan, and you're going to have to, of course, pay an interest rate. That's the call money rate. Now, back in the 1920s, you remember these were called the Roaring Twenties. It was possible, I mean, think about how nutty this is. It was possible to buy $100 of stock with just $5 or $10, depending on what kind of an investor that you were. What is that? Oh my gosh, that's almost 100 years ago. There essentially were no initial margin requirements. Now today, those initial margin requirements are at least 50%. So what you have to do is you've got to put up your own equity. You have to put up your own cash. And whenever an investor uses margins, that's called financial leverage, because what you're doing is you're using just a part of your own capital and then somebody else's capital to magnify your returns. And this works beautifully. The returns are absolutely magnified if prices go up and everybody's happy. But if prices go down, that negative return is also magnified. So you got to be really careful when you use a margin loan. All right, we'll talk about the maximum leverage ratio here in just a second. And that ratio indicates how much extra risk the leveraged position has over the unleveraged position. So here's a good example. Let's go ahead and do some calculations. There's our formula for the leverage ratio, and there's our maximum leverage ratio. So let's go ahead. We've got a margin transaction. So look at the table there. Give some good variables. Let's calculate the leverage ratio and the return on the margin transaction. Sometimes it's called the return on equity if the stock is sold at the end of 1 year. So look at what's happening here. We're buying the shares for 50, and then after 1 year, the stock goes up to $55. Now forget about all this other stuff. Look, what does that mean? If we buy at 50 and sell a year for 55, we can just easily compute that holding period return. That's 10%, right? But we've got a bunch of other stuff going on here. We have a dividend in there, we have a margin, and we have a commission. So we have to consider all that stuff. So just remember, the base holding period return for this transaction is you're buying at 50 and going up to 55. That's 10%. All right, so what happens here? Leverage ratio is going to be 1 over the initial margin requirement, so that's 2.5. And so I want you to think about that leverage ratio as kind of what you get as if you were to buy multiple shares of stock, right? So think about this. When you go to the store and the food store, and my children love these mini bites, and I'll never buy the mini bites unless they're on sale 2 for 1. So you get the 2 for 1, and so I get 2 boxes and for the price of 1. Well, that's kind of what the leverage ratio means. Here, instead of buying 1 share of stock, it's like we're buying 2.5 shares of stock. So this is lots of leverage. All right, so the total purchase price, what are we doing? 1,000 shares, $50 a share. So that's $50,000. So we need $50,000. I mean, when we go to the floor of the New York Stock Exchange to execute this transaction, the seller of these shares is going to expect $50,000. But the initial margin is only 40%. So we only have $20,000 of our own capital, which means we're going to have to borrow $30,000 and pay an interest rate on that loan. We're going to have to pay a small commission of $50. All right, so let's do some calculations. So what happens at the end of the year? There's 1,000 times the 55. So we turned our 50,000 into 55,000. And that's a gain of $4,950 because what did we have to do back here? We had to pay that $50 in commissions. All right. Now, complicating things just a little bit is the dividend paid. So there's $1,000 worth of dividends. Now we've got to figure out the interest on our loan. So we've got a $30,000 loan times that 4% call money rate. That gives us $1,200. The commission on that sale is going to be another $50. And so the gain on the transaction, you can do all the math there. That's $4,700. And the return on that margin account is going to be our profit, that $4,700 divided by our initial investment. And so that includes the $20,000 plus our $50 worth of commissions. This is an example of the beauty of leverage. What did we do? We took an investment that was going to have a 10% return. Now, if we want to include that dividend in there, maybe it's a little bit more than 10%. Maybe let's bump it up to 12%. What did we do? We almost doubled that return because we used leverage. I call this the beauty of leverage. But suppose instead of the stock price being at $55 in 1 year, suppose it were at $45. Well, then all those things turn negative, right? There's no gain, there's going to be a loss. And so that return on the margin account is going to be, somewhere around a minus 25%. So the beauty of leverage occurs when we borrow money and prices rise. The ugliness of leverage occurs when we borrow money and prices fall. So make sure when you interpret this, part of that LOS asked you to interpret, is that leverage means financial risk. All right, how about a margin call? So there's a good formula for the margin call. Here's an example of the ugliness of leverage. If prices fall and they fall far enough, the broker's going to call us and say, remember that initial margin that you gave us? Well, it's not enough to cover the risk of this particular investment, so send us more cash. All right, so here's the solution there. The margin call is going to work through and get to be $20 a share. So we bought at 30. Once that price goes down to 20, then we're going to have a margin call. All right, we're comparing execution, validity, and clearing instructions. All right, so what happens here? When you go to the New York Stock Exchange, or you go to the NASDAQ market. Whoever is there acting as the intermediary, whether it's the traditional specialist or a market maker or just somebody else out there, they're going to ask you to pay two different prices. There are always two prices for financial security. There's the bid price and the ask price. And so what the market maker does is say, hey, anyone who wants to sell, get in this line. Anyone who wants to buy, get in this line. And that difference between the bid price and the ask price is going to be known as the bid-ask spread. And so if the bid price is $100 and the ask price might be $100.05, what the market maker does is he gets the buyers and sellers together, right? That's equilibrium, and then keeps that 5 or 10 cents for him or herself. Execution instructions indicate how an order should be filled. There are most of these are market orders in which you just put in an order and say, hey, buy 100 shares of Procter & Gamble. And so what that is going to result in is an immediate order execution at the best available price. But lots of investors like to place limits on those orders, which are going to put a condition on the order. Like, for example, only fill this order if such and such price is available. And it depends on whether you're buying or selling, and it depends on whether you have a reservation price that is above or below. And so there are all different sorts of limit orders. There's a marketable limit order, there's the new best bid, there's made to market, and then there's a standing limit order. And so I would familiarize yourself with those terms. Validity is defined as when the order may be filled. And so this can be filled throughout the day. It can be filled over some extended time period. It can be canceled. It can be depending on the closing price. It can be depending on the open price. And there can be a stop order or there can be a stop loss order. And these occur so that the investor has some control over the price at which the trade is executed, whether it's on the buy end or the sell end. For example, if you look online and you see the price is $100 per share, let's forget about bid and ask here for just a second, and you might put an order that says something like, if the price falls to $99, go ahead and sell it because I'm worried about it falling to $90 and I need this capital to build a swimming pool in my backyard. All right, how about clearing? Of course, when trades get executed, there has to be a mechanism under which they are cleared, meaning that they are recorded legally, right? This is a transfer of ownership. And then there has to be compensation. There has to be capital flowing back and forth. So clearing is defined as how to arrange the final settlement of the trade. And so typically what happens is that the clearinghouse will have a contract with each different party so that the two parties really don't have to interact. The clearinghouse does it itself. All right, let's define primary and secondary markets and explain how secondary markets support primary markets. I love this LOS, especially the second part. All right, so we said this earlier. What's the primary market? This is where the market in which securities are originally created and they are first sold, and then the issuers receive the proceeds. And this occurs with an initial public offering, and it occurs with a seasoned offering when a corporation issues additional shares of stock that the board had authorized, but they had not yet been issued. And think of the primary market as the market where capital flows to its most efficient resource. And we talked about that in one of the first slides. The secondary market, on the other hand, is the market for securities that have already passed through the primary market. And they're traded among investors. Remember I said to you a few slides ago about think of New York Stock Exchange as the secondary market. Now, so we define these, and I like to go back to that, explain how secondary markets support primary markets. And this is how I think of this. That, here we live in the United States, at least I do, And in other countries, there are free market systems. And what that means is that when businesses or governments need capital, they want that capital immediately. Well, the only way that the primary market can be successful is if it has support from the secondary markets. If I lend my hard-earned capital, let's say $20,000 worth of stock in Procter & Gamble, what am I doing? I'm lending my money to these executives and the board at Procter & Gamble, hoping that they can sell enough soap and shampoo and whatever else they make so that they can repay me by paying me a dividend and perhaps a capital gain on the floor of the New York Stock Exchange. So here's the deal. The only way that that primary market works is if I can go to the secondary market and get my money back immediately. And so what the key element about the secondary market support is that it provides liquidity. The fact that these markets are highly liquid means that investors can trade between and among themselves at almost any instant during the day, means that when the issuers, whether it's a government or a business, when they issue stock or bonds in the primary market, those bondholders and those shareholders know that they're going to be able to get their money back. What that means is that they can raise more capital today, higher initial sales price, and then have a lower cost of capital. Remember, what was that goal of the business back in our corporate finance reading? Goal of the business, maximize shareholder wealth. How do we do this? Well, we invest in positive net present value projects, and we find investors that are willing to lend us capital at the lowest possible interest rate. So minimizing the cost of capital is part of that goal of the business, and the secondary markets support those primary markets. So all of this is really the heart and the soul and the core of the free enterprise system. There are quote-driven markets and there are order-driven markets. So in the quote-driven markets, customers trade at the prices quoted by the dealers. I called these market makers earlier. Most of these trades are conducted through these computer communications. And remember our last reading on fintech. And so this is a great question about how these computer communications and those ledger networks are going to evolve over the years so that these trades can be more efficiently executed. And then the order-driven markets are those driven by the orders, the buy and the sell orders that are matched. How about brokered markets? This is where brokers trade among their clients. And so what happens is that there's an organization of these markets that's maybe unique real estate or watches or fine arts. And only a number of people are really interested in these things. Although part of this really fascination and increased emphasis in the CFA program on alternative investments means that more and more investors are interested, and the availability of these items has increased for investors across all different income levels. How about features of a well-functioning financial system? Well, let's take a big picture answer to that question. A well-functioning financial system provides capital to all of those borrowers who need it the most. And a fair interest rate is charged, and all of the lenders are satisfied with the transactions. All right, so how can we put this in some kind of a formal answer here? There are timely and accurate disclosures, right? So that both the buyer and the seller, the borrower and the lender, knows everything about the contract, knows everything about the underlying asset. All right, it's got to be lots of liquidity, and this helps to minimize trading costs. Markets have to be complete. We call this spanning, so that if you have, think about spanning, let me go like this. If you have a need that comes right here, that you can span the landscape and you can find a security that's going to help you get this right here, whatever that is. And then let's talk about informational efficiency. When fundamentals of an asset or a company or a government change, well, then that has to be reflected in prices. we'll talk about the efficient markets hypothesis, in which Eugene Fama suggested to us long time ago that prices are based on and reflect relevant and publicly available information. And whenever one of those information sets change, like maybe the dividend yield or interest rates, then prices have to respond. How about market regulation? This is really part of political risk. In the United States and other countries, we've had periods of rising market regulations and periods of falling market regulations, and there's pros and cons to both sides. But clearly, efficient market regulation is needed. What this does is it controls fraud, it controls the agency problem, it promotes fairness. There are beneficial standards that can be realized by all parties. And then I like this last one here. The idea is to prevent undercapitalized firms from taking excessive risk. That's an objective. I'm not sure if it's been achieved. And that takes us through our first reading in equity investments. We'll talk about stock market indexes next time.